Hello, I'm Amy Bernstein with Bernstein Realty. I'm delighted, absolutely delighted to have Jennifer Hernandez with Legacy Mutual Mortgage with me today. And I will tell you that Jennifer is not just a person that takes a mortgage. I mean, she is a real educator through the process. And she likes to talk to people and find out what their needs are and do a needs assessment and then put you with the type of mortgage that she thinks is best for you. And she'll talk you through all your different options. So she works with a team of people. She's the front person that you talk to initially, and then she works with the amazing group that's all been with her for a very long time, and just makes the process really smooth, easy, and painless. And I know from a real estate standpoint that when you use Jennifer, her money will be at the title company at the closing. So sometimes people drift off and they find an internet lender or somebody they don't know, and then you have to chase them to find out where they are in the process, and are y'all going to be ready for closing, and they may or may not return your calls. None of that happens with Jennifer. You can count on her to be at the closing with your mortgage. So that is one thing that I think is the most important thing, because you have earnest money and other things at risk. So thank you, Jennifer, for being here today. I really appreciate it.
Yeah, thanks.
So tell us a little bit about the mortgage. Like, if I have a customer and I say, call Jennifer to get pre-approved, because when we write contracts for homes, the listing agent is going to want to see a pre-approval letter. So the first step in the process is to talk to a mortgage person like Jennifer, and she will talk to you, do your loan application, and issue a pre-approval letter. And then you'll give that pre-approval letter to your realtor, hopefully a Bernstein Realty agent, to present for you on your behalf when you make an offer. So tell us how that process works.
Yeah, sure. So I always like to have an intro call. I call it a discovery call, 15 minutes with everybody, because we need to assess how fast, how slow, what's their situation. There might be someone you might be watching and you're like, I don't even know what I know. I'm 9 to 12 months out, which is my favorite time to talk to people, by the way.
Oh, really?
Oh, yes. Because there's a lot of misinformation out there. There's so much over information on the internet and TikTok videos, let's face it, people don't even know what to believe. So I like to get them early. I wish it was always that simple, but regardless, I always have an intro call with people that just assesses stuff, lets them get to know me, etc. And then we determine the next steps from there. But let's say we have that conversation. They're like, no, we're going to buy in the next 3 to 4 months. The pre-approval, we can do it many different ways. And again, it comes with the needs assessment of the client. There's a lot of companies these days that they're like, oh no, you have to go to the portal. Well, I take them by hand. I've had some clients.
You know what? That's kind of like when you go to the doctor and they say you need to go into my chart. You gotta go to my chart.
Yeah. So I try to assess the technological capability. Some people don't want that. They want this or that. So either way, we get their information, okay? Portal, on the phone, in person, any of those ways. And then the most important part that I want to implore people understand is the document part. And I'm going to give you an example that just happened to me this morning. A pre-approval letter that you feel good faith giving to a listing agent means that they've been checked out.
Sure.
And to check you out, we have to see your documents. Like the letter says, we've reviewed your full financial situation. So if we haven't, number one, that's lying.
Yes.
And number two, it opens the door for mistakes to happen later on. So this just happened to me this morning. This realtor, if I told you his name, you would know him. Good guy. This client fell into his lap by a referral. They went out one time and they saw the house they love. Like who knew?
Yeah.
They have no lender. They put in an offer and said, okay, by the afternoon, we'll have you the letter. And they're coming to me on the side like, Jennifer, we need a letter. So their hair is on fire, okay? She put on the application that she makes a certain amount per month. We get the pay stubs, and it's less than that. So it's a classic example of just questions. Now I still haven't finished the diligence, but
It's a puzzle that you put together.
That's a perfect word.
Yeah.
It is a puzzle that has to be documented. And it could be that she really makes that, but she might not have been getting bonus for that long. Like,
Yeah.
I don't know what the answer to the question is, but I have to dig and I have to find out, because the last thing anybody wants is a week before closing to find out that there's a problem.
Yes.
So the process, to answer your initial question: discovery call, application, which is really just credit application.
You don't really meet with people today anymore. It used to be like, where's their office? Where do I go? You do it all on the phone, I guess, right?
We do. There are people for sure that want to come see me, and I love and welcome that. I've kind of forced us to do a Zoom call at the pre-approval part. Maybe not initially, but like at the part where we're talking about numbers and documents and stuff. I want to meet everybody. So some
Yes.
people are like, no, I just want you to call me. I'm like, okay. So it depends. But
Gotcha.
I like people to see who they're dealing with,
Gotcha.
for sure. Yeah. But usually they've watched a few of my videos, so they feel like they know me already.
Yeah.
But anyway, the process really is meant to happen very quickly. It does not take me, once you get me the documents. Most lenders, if they're organized, once they get your documents, I mean, within 36 hours you should have. Sometimes there's back and forth, like with this client, but we're doing it right away, right? It doesn't take that long. But the key that I want to implore everyone to understand is, for an actual pre-approval that you are going to make offers with, you need to be prepared to submit some documents, because what we can prove on paper might or might not be what really reality is.
So what should people pull together when they're looking for this?
Yeah,
When they
that's a great-
like, how do you prepare to have this? If I was in a hurry and wanted to get it done, what do I pull together?
Yeah, perfect. I like to tell people 222. We need 2 of everything. 2 pay stubs, 2 months bank statements, which would be banking, checking, 401k, stocks and bonds, whatever your banking statements are.
Gotcha.
And 2 years W-2s. If you own your own business and you do your own thing, we need tax returns if you don't have W-2s.
So if you're self-employed, you need a tax return.
Yeah.
Okay.
Yeah, 2 years. So just remember 222.
And that's it. So
Yeah,
it's not
that's
that
it.
arduous of a process, really.
No, I mean, sometimes there's other things, like if you've been divorced, we have to have a divorce decree. If you have income from other areas, Social Security, we might need the Social Security award letter. So, I mean, there's some divots here and there.
Right.
But for the most part, 222.
So tell us, or tell the viewers, what it takes to qualify for a mortgage today. What are the ratios and how does that work?
Yeah, so if you're putting less than 20% down, it's a little bit different. So less than 20% down, you really need to have your debt to income ratio 45%.
And elaborate on that.
That means that your monthly income versus your monthly debts, including the mortgage, and we use gross income, by the way.
Gross income.
Before
So it's
taxes.
so you're saying that the monthly payment for the house, principal, interest, taxes, and insurance, plus any long-term debts.
Yeah, like
10 months owing or greater, or what is considered a long-term debt?
Yeah, I mean it's any installment. Long-term is a great word for it, like a car loan, etc.
Student, what are those? Student loan,
student
car
loans,
loan,
car loans,
child support.
Credit card balances. Now, on credit cards, we just take the minimum payment. You might pay more, but we take just the minimum. So
Okay.
any of those debts added to your mortgage can't be more than 45%
Of your gross
of your
monthly
gross monthly income.
45%. Well, that's gone up, and because it seems like not even 5 years ago it was like 36%.
So if you're getting a loan, and I know you sell a lot of big houses, so on the loans that we call jumbo, which are loans as of January 1, it will be over $798,000. They're increasing
So
it.
I want to circle back to that. But so 45%.
Yeah.
That's pretty great.
Yeah. Now on the larger loans though, they're pretty much at a hard 43.
Okay.
The bigger, what we call jumbo loans.
So 43 to 45%.
Yeah. Now, if you're getting what's called a FHA loan, which is someone that might have, lower credit, we allow higher debt to income ratios. FHA is the loan called Federal Housing Administration. It's the one subsidized by the government. Those will go up to almost over $500,000 now. So I mean, that's
wow.
It's a big loan.
So how long does somebody need to be employed before they can? Let's just say that we have a new graduate that's starting a brand new job. Are they able to get a loan today?
Yeah, you need to have a 2-year history, but being a graduate that's been in school training for their job is an exception. So you bring up a good point. But 2-year history, and there's a lot of people coming into the U.S. that are professionals, and they're like, hey, my history was in another country. That's okay, as long as we can verify that you have a 2-year history. As long as that company is available, we can see that you're making money, we can verify employment with that company. I got employment verified in Cuba.
Wow, pretty good.
Hey,
nice.
Yeah, Cuba. So he was a teacher, thank goodness. So it was
and you
kind
speak
of
fluent Spanish too, so
I'm fluent Spanish.
Yeah, that's really nice to know.
Yeah.
So, what do you see in today's market? Are you seeing that people are putting a lot of money down? Are they going? What is the benefits of putting? Tell the viewers what the benefits of putting 20% down is.
The benefit of 20% down is that you don't have private mortgage insurance, which is an insurance that you pay to the lender just for the risk.
On behalf of the lender.
On the behalf of the lender.
Which can usually run about $100-ish a month or something like that.
It's hard. It's hard to say. It depends on the loan amount, and it depends on your credit score. So the higher your credit score, the lower the amount is.
And they call that in the industry PMI.
Yeah, private mortgage insurance. And then you also get the ability to choose whether or not you want to do escrows, your tax and insurance, what we call escrow, monthly or annually. You get to choose.
Most mortgage payments include principal, interest, taxes, and insurance. Some people, if they put 20% down or greater, don't have to pay the taxes and insurance to the mortgage company. They can wait until the bill comes out at the end of the year and pay that separately. But if you put less than 20% down, the lender requires you to pay principal, interest, taxes, and insurance monthly. So that's one of the benefits if you put 20% down or greater. So are you seeing today a lot of people still getting the loan of the 80-10-10s and things like that? Or
I really do not. So what she's talking about is where people would put 10% down, but they would split it between an 80 and a 10. I haven't done one of those in a long time.
Really?
Yeah, PMI, private mortgage insurance these days, is really so cheap when you have good credit.
So people would rather just do the PMI.
Yeah, it makes sense. And the interest rate is lower if you do it all combined into the loan.
Nice to know. Mm-hmm. So when somebody wants to buy a home and they're anxious and they're just starting a job, so they have a great income but they don't have a lot of savings, what are you seeing is the minimum down payment today to get into a home?
It depends on if you're doing one of the jumbo larger loans. I know you do a lot of houses in that range. You need to put 20% down. I mean, if you put 15 down, they will get you in that interest rate. But 20% down on the bigger homes. But if you can be in that conforming loan limit, which starting now, really the limit is a loan of almost $800,000.
That's shocking.
It's huge. Like
so
you can do
5%
down.
5% down.
Yeah.
So let's talk about that to educate the viewers. So it used to be every year it seems like, well, let me backtrack. There is conforming rates and non-conforming. Conforming rates are loan amounts up to now $798,000 of a loan. I would say 5 years ago that was below $500,000. So now the rules are they're allowing you to borrow more money and still only put 5% down because you're staying within the conforming loan limits of $798, which is amazing. Mm-hmm. Anything over a loan amount of $798 is called non-conforming, and that's where you have to put 20% down. And is your rate higher as well when you do that?
When you put 20% down?
Mm-hmm.
So it's interesting. It depends on your credit score. So depending on your credit score, 20% 20% down, sometimes the rate is slightly higher than if you put less money down. I know that makes no sense.
Yeah.
But yeah, on these conforming loans. And that's because the lenders want the PMI because it's their security blanket. So
Yes.
they give a premium for those
Oh,
loans.
so they try to get you.
Yeah, because they
get protection.
They get protection. Yeah. Actually, the new mecca for lenders is actually 25%.
Really? Boy, things change daily.
Yeah.
So let me ask you a question. When people decide they want to buy a home and they call you and they tell you what they want to put down and what their rates are going to be, usually these buyers, especially customers of mine, will shop around the rate, right? And so I always like to tell buyers, it's not just the rate that you're shopping for. You're shopping for the rate and you're shopping for the fees to get that rate. So when people go and they shop for mortgages, they can't just ask what the rate is because everybody's fees are different with the rate. So some lenders may go for a really low fee but charge you a really low interest rate and charge you a lot of fees. So it's very important that you understand both. Tell us a little bit about how your company works.
We work, all the companies really work the same. How we present it to the clients, like I'm super transparent. The base rate is the base rate, and then on any given day, anybody can buy down to a lower rate. It's called buying mortgage points. You can call them discount points, mortgage points, origination points. It all means the same thing, and it's that higher closing cost that you were talking about. So if the client wants to do that, I'll usually show clients now several options so that they can see, because there's a lot of non-transparent lenders out there. And in fact, when you're looking online, it is very common that the sexy blinking rate that's going to catch everybody's eye,
Yes.
it's called marketing.
Yes.
It's called marketing, and it doesn't mean that they don't have that rate. It just means that there's possibly costs associated with it that you just can't see on that internet page,
Yes.
right? Like they only have so much room to disclose stuff. So I think what, to your point and what Amy says is crucial, make sure you get stuff in writing and so you know what's what, because every lender has lower interest rates.
Yes.
It just depends.
It's all negotiable.
It's how much you're willing to pay for them.
It's all negotiable.
You know?
So when you shop for mortgages, it's just like shopping for anything, and everything is negotiable. So you need to find out what the rate is, what the interest rate and the cost of the money is, and how quickly that lender can get the job done. Because some lenders take longer than other lenders. So these are the questions that you have to ask. Now, once you get satisfied with the rate and the fees, you have the ability to lock your rate. And you have to ask the lender how long of a rate lock that is. So talk to us a little bit about what happens if I borrow money, I lock my rate, and rates go up. I'm protected up until the time the
You're
lock
protected.
expires.
Yeah.
But if rates go down, then I'm bummed.
If rates go down, yeah. So it's kind of like the unfortunate reality is like, let's say you buy a stock today and then you go, and then it like shoots up the next day.
Then you're thrilled.
And you're like, yeah, you're thrilled. But if it goes down, you're like, hey, I didn't mean to buy it at this price. I want to buy it at that nice low price. Your stock guy is going to go, sorry,
Yeah.
but like you've already done it. It's the same, because if lenders kept,
popping in and
popping out. No hedge funds and the big lenders, the Oz's behind the curtain, none of them would want to do business with us because we're not keeping our commitments.
Yes. I get
So
that.
lenders,
So we either lock and be happy with the rate you have, or risk it and what's called floating until you're ready to pull the plug and lock.
you play the market.
Yes.
But you have to lock in at least 10 days before closing,
Okay,
because
good
we have
to
to
know.
go back to underwriting. We have to do all the legal docs. Like in a 30-day closing period, honestly, the rates hardly ever go down. They go up before they go down. So I tell people, listen, unless you're a big-time gambler and you're sure on yourself,
Yes.
you need to close your eyes, you need to lock it in, and you need to stop stressing about it.
Yes.
Because there's other things that you can stress about.
Yeah.
And, at some point you've got to pull the trigger, because in a 30-day period, we don't have very much time
Yes.
to recover. So let's say you're playing the market and you're like, no, I'm a gambler, I'm going to just see what happens. Well, let's say in a week the rates go up.
It's kind of like playing blackjack,
Yeah.
If you put down $100, if you put down $25, and then you get a blackjack, you're like, I have to put down $100 on that
Yeah,
hand.
that's
so
right.
I totally understand that.
Yeah.
So there's a lot of conversation today about rates, right? There was a big news where 2 weeks ago the Fed dropped the rate, and I had a lot of my clients calling and saying, oh my gosh, can I get a lower rate? Can I get a lower rate? Interestingly enough, it's not always when the Fed drops the rate do mortgage rates drop too, right? How are they associated like that?
So it's a great question, because it's the biggest mystery out there. But it's first important to understand that the Fed rate that they influence and they control really is the federal funds overnight rate that they lend to big, huge banks and corporations. Like let's say you're a big, huge bank and you have depositors and they take out a bunch of money and you're like, ooh, I gotta cover all that money that they just took out. You're gonna go get an emergency loan from the government overnight to cover, so you don't bounce a check, right?
Right.
That's that rate. So this is the rate, the Fed rate is the rate at which big companies borrow money overnight to cover
Gotcha.
their loan coverage. That being said, it definitely influences what's going on, for sure. Like the trend is definitely downward, but you have all these little spikes in between. And what happened in the last 10 days actually is rates have actually gone up.
That's what I heard.
Because the inflation numbers are coming out, the economy numbers are coming out, things are booming according to the government. I don't know if I buy it. I have a feeling they're going to come revise the numbers, but that's the information that we have to deal with right now. So you just need to remember that mortgage likes bad news. And so when there's something that we're being rescued from, like a crash or a recession or, oh my gosh, unemployment's super low, that's when the mortgage rates usually go down, when there's some type of a crisis like that.
Gotcha.
So when the news is good and hey, everything is fantastic, well, that's actually where mortgage rates are going up. So you've got
That's so interesting.
Yeah. So the trend is definitely downward, and I think that the mortgage rates, as far as we know, are expected to trickle downward over the next couple of years, unless there's some type of crisis, which we can pick a dozen things and be wrong about all of them, that could happen, and the government needs to swoop in and rescue. They rescued us during COVID. They rescued us during the mortgage meltdown in 2008, right? Those were rescue operations, okay? We don't know what's in our future. So the thought is that they're going to trickle down over the next couple of years. How fast? I have no clue.
Does the election, or I can't say it does the election, what does the election impact have on this?
I have a feeling that the numbers that are coming out kind of are influenced. I think there's a lot of deeper things at hand that you and I, it's just too much capacity for us to understand.
Right.
Like, oh, these unemployment numbers are fantastic. And then a month later they come in and they revise them. Oh, we didn't mean to say the job grew by that much. It really grew by this much. So a lot of that kind of goes on. So, it is 24 or 5 days from election period. So
I'm so ready for the election.
I'm sure they want,
Irregardless of what happens. I am so ready for this election to be over.
I think indirectly it definitely is an influence, because people are kind of holding their breath.
Yes.
Because they don't know if policy is going to be more conservative, so in a certain way, but no one comes out and says it. Yeah. But it's impossible to think that it's not.
I said to myself last week, I'm going to mark my calendar for every 4 years to know that the months leading up to the election are always a
little tricky.
They're a little tricky, and people are very hesitant.
Yeah.
So what do you tell people that go, I'm just going to wait. I'm just going to wait until rates go down? I know that I've heard the expression over and over since January, marry the house, date the rate.
Date the rate. There is some truth to that. That's kind of a tricky tagline that someone coined. But I think that honestly, if something works for you, it depends on your situation. I had a client who they're busting out of the seams. Like, they live in a little Heights bungalow and they have 3 kids now. We did their loan years ago. And he's like, Jennifer, I don't care that I have a 3% rate.
That's the problem.
Going crazy.
That's the problem.
But they're going to rent the house
Yes.
and make a huge overage between rent and their mortgage,
Yes.
which is a great investment.
Yes.
Because they can qualify to buy a house without selling
That's
their
so
current
nice.
one. So
because it's these people that bought in the last 5-10
Mm-hmm.
years that have rates that are so low that I'm finding are wanting to remodel or add on because they do not want to lose that 3% mortgage.
Here's the thing, though. At some point, it depends on everybody's situation.
You can't hold on to it forever.
You have to live.
Yes.
If you're going to remodel, listen, how expensive is a credit card?
Yeah.
So if you're going to have a little bit higher rate, but overall, like, we've had people that they've paid off credit card debt and they're paying 25-26% interest on credit card debt.
Wow.
They're gasping for air month to month. And I'm like, and it's an older couple. And I'm like, hey, we need to cash out on this equity. We'll even out and get you fixed payments.
Yeah.
It doesn't matter that you have 3%. They're
Yeah.
like, oh, you're
Yeah.
right.
Sometimes it's just
So,
a number for sure.
It's just a mental
But at the
thing.
end of the day, it is, it's very seducing to people. Well, my first home, guess what my interest rate was?
It's
So I bought
probably
my first home
18%.
at 16 7/8.
Yeah, and you thought it was a bargain.
No, I knew it was high. But now when rates became single digits, 9, and when rates got under 10, I was like, this is unbelievable. So when I hear people complain about 5 and 6%,
Yeah.
I just laugh because at the end of the day, it's all relative.
It's
But
all
if you
relative.
did have a mortgage before at 3.5% or 3%, even I have some at 2 3/4, and you have a rate anything below 5%, and you get transferred or you want to buy a bigger house, you're a little more hesitant, but you do it.
Okay.
If you do want that bigger house.
Here's what I have to say to that.
Yes.
COVID was never supposed to happen, and it did. And if you have 3%, that is the gift
That's
that
a
you
good
got.
point. I like that.
And the equity that these people have. No one's talking about that.
Yeah.
You would have never, if COVID hadn't happened, you would have never had, at least in Houston, the explosion of equity that we've had.
Yes.
And things have flattened out,
Yes.
but you're still at a higher level. So, I mean, everything is very relative. Yeah, you have 3%, but look at all that equity.
Yes.
So, and that's the wealth transfer, right? Like, that's the benefit of owning real estate, is that you buy it at a certain point, you accumulate this extra value.
Yes.
And then when you're going to move up to the next house, you're taking that and putting a nice big down payment on the next house.
Yeah.
So, I mean, we could sit here and go through 100 scenarios.
Yes.
I just think that if it makes sense for you to move, if it makes sense for you to buy that first home, to be having a tax deduction, instead of wasting money on the landlord, him getting the tax benefit, but
Yeah.
you get nothing, right?
Yeah.
Like, there's a
benefit.
We could look at it a lot of different
Yeah,
ways,
I agree.
and I think that at some point,
It's not always about the rate.
I just think that you just can't put your life on hold for too long.
You got to know when to go and
You
know
gotta
when to
know.
hold them.
And if you find the right house and it's the perfect thing and you're a growing family or this, that, or the other, I mean, it really makes sense for some people. Now, for some people, it makes sense to wait. And I tell people that. I'm like, listen, you need to wait, get your credit under control. Rates will be lower next year, and that's good for them.
Yeah.
And then there's other people where I'm like, listen, I mean, how long are you going to live in a 2-bedroom house with 4 kids? I don't know.
Yeah.
I
That's
mean,
exactly.
psychiatry ward is a lot more expensive than a little bit higher interest rate.
Exactly.
So yeah.
Well, Jennifer, this has been super helpful. If people are in the market and they want to talk to you and get qualified and see what they can qualify for, how do they contact you?
Yeah, so my website's the best way. It's Loan with Jen, LOANWITHJEN,
I like
and it's
that.
got
Oh,
all
one N.
my one N.
Okay.
Loan with Jen, and that's they can find me.
Nice.
Yeah.
Well, thank you, Jen,
Thank you.
so
It's so
much.
good to see
So
you.
much for being here
Yeah,
today.
you got
You
it.
know, when we wanted somebody on the podcast talking about mortgages, there was just no question that I wanted to call you. So thank you very,
thank
very
you.
much for being here. So thank
See
you
ya.
very much for tuning into our podcast. We hope that you'll tune into future podcasts. And our goal is for you to always walk away with a little more knowledge than you tuned in with. And remember, your home is our expertise. Thank you.